Hey everyone, it's Dan here. In this video, I'm going to talk about how to use the income statement and the balance sheet to evaluate companies. If you're new to the channel, my name is Dan. This channel is all about saving and investing your money. So if you're into that kind of thing, hit the subscribe button so you can check out my other videos. Alright, let's jump into it, guys. We have 4 financial statements. I'm just going to cover 2 in this video. They're definitely the 2 most important, the income statement and the balance sheet. This little statement right here, statement of retained earnings, it really just a mini statement that ties the 2 together. Then you end with a statement of cash flows. Very important statement, but deserves its own video. It's pretty complicated. Balance sheet. Balance sheet is a snapshot. This is a point in time for your company here. So you're at the end of your quarter or end of your year, and at that point, you just say, stop, let's add up all the assets. That's anything of value that we own. Let's add up all our obligations, money that we owe others. That's called liabilities. Total assets minus total liabilities. The ending result of that is the equity in the company. Equity is therefore sometimes called net worth, which makes a lot of sense, right? You add up all the stuff you own, you subtract all the money you owe other people, that's your net worth. It's also sometimes called book value. This is the book value of the company from an equity holder's perspective. What I mean by that is from a shareholder's perspective. Because if you think about it, this equation, if you don't subtract liabilities and you look at it, it's saying that all of your assets are either funded by debt with these liabilities here or equity, money you got from shareholders. So if you take the assets and subtract the portion that are attributable to the debt holders, you subtract the liabilities, that's the slice of the company that's going to the equity. Now, little side note here, equity has 2 parts. You have money that you receive from shareholders when you sold your stock, that's capital stock, and you have retained earnings. That's money the company has actually earned and has retained in the company. They haven't paid it out as dividends, hence the name retained earnings. Okay, let's look at the income statement here. The income statement is different from the balance sheet because it covers a period of time rather than a point in time. So if we're looking at the year ended December 31st, 2020, that means like the whole year. During this year, what did we earn in revenue? What kind of expenses did we have? And therefore, what was our net income, aka our profit for the year? So here I just made up a fictional company, but this is typically what you're going to be looking at here. You got the revenues, that's all the money we earned. You got 1.6 million. I'm going to subtract a bunch of expenses now. Now they always go in a predictable order. The first expense is always cost of goods sold, sometimes called cost of revenue. This is just the cost of making the physical products, okay? Money you paid laborers to put the products together, depreciation on the machines that made the products, the cost of the materials of making those products, that's all that goes into that expense there. So you take revenue minus cost of goods sold, and we call that gross margin. So for this company, after paying for the cost of products, they got a $900,000 profit. But wait, there's more, of course. We got to subtract operating expenses. And those will vary from company to company, but I'm listing typical ones you see. SG&A expense includes a lot of salaries for office employees and things like that. Depreciation expense on things like the offices and the stores of the company. R&D expense, advertising expense, interest expense, etc. Once you subtract all those, we call that operating income. Then you subtract your income taxes, and you sometimes also subtract what we call unusual items that won't recur again. Like we had an earthquake and our insurance didn't cover it and we lost the building, this won't happen again sort of thing. And you subtract things like that, and then you get to net income. Now, why are those expenses separated from your operating expenses? Well, because we think they won't happen again. So as a practical matter, even though net income is your what we call bottom line profit, sometimes financial analysts focus on operating income because they view that as a more stable measure of the company's profits. Assets equal liabilities plus equity. And we have many different kinds of assets here. You got cash, you have accounts receivable. Anything that says receivable on it, that is money that is owed to us. Okay, so in accounting, we call that an asset. That's money that is owed to us. It's a very good asset, actually. It's the second most liquid asset. You'll notice the assets are listed in order of liquidity, meaning how fast they can be converted to cash. So cash is always the most liquid asset, but the next most liquid, of course, is accounts receivable. Then you have inventory, and then you get into things that are not very liquid. You got land, buildings, equipment, copyrights, patents, trademarks, things. Then you have liabilities, and they all have something in common. They all have the word payable on them. Anything, with the word payable in it is a liability, and that just represents amounts of money that we owe others. Now, balance sheets are always classified. They fall into different categories here. You'll notice we have current assets, and then we have some other kinds of assets. These are all non-current. Current assets are those we expect to convert to cash or use up within 1 year. Current liabilities are those that we expect to pay within 1 year. So that's very important to understand. Even if a company's liability situation looks okay, it's important to check in and see, well, are they going to have any short-term liquidity problems? Let's look at their current liabilities and compare those to their current assets. That's something you can do once you understand financial statements. So if we look at their balance sheet again, with that in mind, we do see that their total current assets are much more than their total current liabilities. This company is very safe from any short-term liquidity issues. In general, the company is very safe. You notice their total liabilities of $665,000 are much less than the total assets of the company. Okay, so where do you get this financial information? You can go to the SEC's Edgar website and type in the stock ticker if you want. I'll look up Caterpillar. And once you do that, you get all of their filings. So companies have to do lots of filings. We're most interested in 10Q, that would be the quarterly report, or the 10K. So what I can do here by filing type, I can look up 10K, get the most recent data there, so that's probably for the fiscal year ending December 31st, 2019. So you can open it up. It's a huge report. There's a lot in there. But if you scroll down just a little bit, most companies will have a table of contents, and you got hyperlinks in there. So for example, item 8, it's always item 8, financial statements and supplementary data. You just click on that, and it takes you right down to the financial statements here. And once you do that, we'll just move right on to the income statement. Income statement's always the first one. As you can imagine, it's quite an important statement. And what we have here, they give you 3 years worth of data actually. And the data are in millions. Now, this data is not so useful though. It's very hard to copy it, and put it into Excel or something. It's a little messy. So I prefer SeekingAlpha. So I'm at SeekingAlpha.com. I'm going to put the link in the description below. But this is a cool website. You can type in any stock ticker you want in the search bar up there. I've typed in Caterpillar. It takes you to this page, and then click on Financials. Once I do that, I'm taken to the income statement. By default, it looks at annual data, but I could look at quarterly. It's looking at absolute values right now, which is fine with me. I can look at that and see, okay, well, revenue went down, then in 2017 it went up again, and then, okay, it's trending up overall. So one thing we can do is click year-over-year growth instead of absolute value. So we see in 2017, revenues went up almost 20%, then they went up 21%, now they're down 2%, now they're down 21% in the most recent 4 quarters. Interesting. We can also look at everything as a percentage of revenue in that year. Sometimes this is called a vertical analysis. It's pretty useful. For example, let's scroll down to net income. And we see that net income as a percentage of revenue is about 5.3% in 2015. It was, very low the next couple of years, and then it jumped up to a little bit over 11%. This is sometimes called the net income margin or profit margin. It's a very useful measure, right? Because you're taking your net income, dividing it by your revenue. That means for every dollar of revenue, how much do you get to keep? Well, we get to keep about 11 cents. That's very good. That's a great improvement from where it was at in previous years. Let's switch it back to absolute value. You can also look at things like R&D expense and see how that has changed over time. And what I see with this company, they're not investing a whole lot in R&D. They're not really ramping it up. That would be a major concern for a technological-oriented company. For Caterpillar, I'm totally fine with that. Let's click on balance sheet. So just like income statement, with the balance sheet, I can look at annual or quarterly. I'm going to look at the quarterly. One of the reasons I'm going to do that is the balance sheet is at a point in time, remember. So I don't really care so much about the trend. I care about what it is right now. How much debt do we have at this moment? So what I'm going to do is look at their latest report for September of 2020 and see where we stand. One thing I can do is look at it as a percentage of assets. That's pretty cool. Okay, so what that tells me here is the following. Let's see here. My current assets represent about half of all of my assets. So that's pretty good. This company is pretty liquid right now. I can also look at total current liabilities, which are only about 32% of total assets, whereas my total current assets are 50% of total assets. So my current assets are easily covering my current liabilities. So we're not going to have any problems in the near-term future with those current liabilities coming due and us not having the money to pay for it. And you can look at total liabilities as a percentage of total assets. Now they're right about 80%, which is pretty high. This company has always kept it at 80%, it seems like. So that makes me feel better a little bit, but it is a bit high. So as you can see, financial statements are really not so bad once you get the hang of them. I hope this video really helps you get started in understanding financial statements, and I hope you find it useful for your investing. If you do, please hit that like button. It helps me a lot. Thanks for watching.